There's a number sitting on your reinsurance statement right now that can wipe out 6 or 7 years of profits, and by the time you actually see it, you're already 3 or 4 years too late to do anything about it. That number is your loss ratio. And here's the part that should keep you up at night. A loss ratio is a trailing indicator. By the time you see it hit 100% on your cession statement, the damage was done years ago. The contracts that blew it up were written 3 or 4 or 5 years back, and you're just now getting the bill. And the only way to fix it at that point, you've gotta raise prices in your finance department so hard, so fast that your finance managers will look at you like the products are suddenly unsellable. I'm talking about a rate increase so steep it could break the very department that's supposed to be feeding the whole machine. I've walked into this exact situation in real stores. A dealer 6 or 7 years into building a reinsurance company. This was something they were counting on using to help them buy their next store and expand their dealer group, or maybe just hand down to their kids for the next generation. I saw this cession statement starting with a loss ratio at over 100%. The dealer was wondering how it got there because the numbers look great 3 or 4 years ago. Let me show you how that can happen and how we fixed it and how we can make sure it never happens to you. If you own or run a dealership and you've been seeding into a reinsurance company for a few years now, this one's for you. Whether that company is the nest egg you're gonna borrow against to buy your next rooftop, or it's the thing you planned on handing to the next generation so they'll be able to inherit something real. I've spent 19 years going into underperforming finance departments and figuring out how to move the needle fast. And over those years, the reinsurance side has shown me a pattern that costs dealers more money than almost anything else in the store. It costs them that much money because it hides. It hides for years, looking like a win, right up until it becomes a catastrophe. Stick with me because the most important part of this video isn't the problem. It's the math that gets you out of it and the structure that turns your reinsurance company into something worth more than the dealership itself. Do me a favor, hit subscribe so these solutions keep showing up for you. All right, let's get into it. About 6 months ago, I walked into a dealership and we got the chance to sit down and really review their reinsurance position. Now on the surface, nothing looked wrong. Their F&I numbers have been solid for years, but when we pulled the book apart, the red flag finally came out. Their loss ratio on the entire book of business from inception to date after 6 years of writing was 104%. And it got worse. Their year-to-date loss ratio on the current book year-to-date was running 160%. Now, how does a dealer get to 104% without seeing it coming? Let me take you back 6 years because that's where this actually started. 6 years prior, this dealer made a deal with a brand new provider. That provider came in and made the pitch that every dealer wants to hear. We're going to move the needle in your finance department. And here's the thing, they did. They absolutely did move the needle in a very short period of time. The profit went up right away. But how you move the needle actually matters. What the provider did was they came into the dealership with lower rates on the products, got the general manager and the finance manager super excited because now they had less costly service contracts. So the dealer thought that was a win and they were gonna move the needle. Okay, well the premium reserve per service contract actually matters. So the lower costs meant less premium reserve per service contract. So the finance managers were happy because they were saving hundreds of dollars per contract on cost. And they're capturing the difference in gross in the F&I department. The number went up immediately. Everybody was happy. It looked like a big win. The dealer thinks he made a great decision. Here's what nobody saw. That company didn't grow the pie. They just reached into the dealer's back pocket, the reinsurance company, where the premium was supposed to be there. It was supposed to be their reserve to pay future claims, and they moved that money to the front pocket where it's now visible, the F&I gross, and it made it look like they had a huge win. It's the same dollars, different pocket. It looked like growth, but it was just a magic trick. And the bill doesn't show up for 5 or 6 years because a loss ratio is a trailing indicator. You write a contract today, but the claims come in over the next several years. So for the first few years, everything looks fine. The premium's sitting in there, the claims start trickling in, and the ratio looks healthy. Then the contracts mature and the claims pile up. And one day you look down and there simply wasn't enough premium in there to begin with. 104% 6 years in. So I started by asking the dealer a few questions. The first question I asked, when was the last time you had a rate increase on your products? The answer, 3 months ago we had the first rate increase. The first rate increase in 6 years. So I asked him to think about his own service department. Are you charging more for labor today than you were in 2020, 2021, and 2022? And the dealer said absolutely yes. They took a labor rate increase every so often throughout that time period. So here's the trap. The cost to pay the claim on parts and labor went up every couple of years for 6 years, but the premium reserve to pay those claims never moved, not once, for 6 years. And there's the question that I really wanted answered. Every time that dealer took a labor rate increase, did his provider come in and say, hold on, we've got 3 or 4 years of contracts written at this previous claim cost at the old labor rate. If your labor rate's gonna go up, we're not gonna be under reserved on those, on every single one of them. To protect your reinsurance company, you either need to write a check into the trust for a large amount of money to catch up on that labor rate, or we need to take a rate increase on the new business to make up for it. That conversation never happened, not once in 6 years. And the reason it never happened is the same reason this whole thing started. That provider was all about the front end, the F&I number, the per copy. They were terrified that walking in with a rate increase would hurt the F&I gross. The very thing they used to win the business was low rates and that they were gonna move the needle. So they just didn't have the conversation with the dealer. They were afraid to go in there and say, hey, you need a rate increase. Your claims are outrunning your reserves. When you got parts and labor inflation, the medicine is premium. You add premium or you have a problem, and you won't see that problem for 3 or 4 years until it shows up as a catastrophe on your loss ratio. So here's where it gets interesting. What do you actually do once you've already hit 104% loss ratio? Step one, we looked at their average cost of claim on an earned basis. And honestly, that number was fine. It's about $650 a car. The claims themselves were not completely out of control. The problem was the other side of the ledger. The average premium they had reserved since inception was about $625 a car. Think about that for a moment. They were reserving $625 to cover $650 in claims. They were built to run over 100% loss ratio from day one, and it was never going to work. The math was broken before the first contract was ever written. And what's worse, this provider had pitched them that those rates would run a 50% loss ratio. So I asked the dealer one simple question: what loss ratio do you actually want to run? And that's the question you need to ask yourself if you're a dealer. This dealer said 50%. I said, okay, now the math gets easy. If your average cost to claim based upon the last 6 years at these franchises on an earned basis is $650 and you want to run a 50% loss ratio, then you need to reserve at least $1,300 a contract, and that's the starting point. And that's before we account for a single dollar of future inflation. They were at $625. The target was $1,300. So the cure, it was real surgery here. We shut down the old program that was running off the rails, and we let that administrator who priced that premium eat all the losses. It's their fault. They mispriced it. So let them have it. That was their bad math. Let them have it. We took everything we learned from that experiment and we started fresh. We calculated the loss ratio that we wanted to run, and we built the premium we needed from day one. And here's the part I want you to hear because it ties everything together. When we raised their rates by $650 a contract to fix the reserve, we uncovered a second problem. Their F&I department, before we got there, they looked great. But now, once we increased the rates, we realized that their F&I department was underperforming. It only looked good because it was running at artificially low product rates and premium rates, not enough to cover the claims. That low rate was a crutch. The minute we put a real rate increase in front of them, the weakness in that F&I department got exposed, and we had to fix that too. That part got solved through performance coaching, and I'll come back to that at the end of this because it matters more than you think. The loss cost math Figuring out your cost of claim on an earned basis, picking your target loss ratio, and backing into the right reserve is exactly the kind of thing that we walk dealers through on a step-by-step basis on a webinar we hold monthly. If you want to run these numbers on your own, book that webinar. That's the room you need to be in. All right, let's say we lay this out clean, because this is the difference between a reinsurance company that builds wealth and one that quietly bleeds. The old way is a provider who earns your business with lower rates on the products you sell and finance. And I want to be fair to your general manager, your finance manager. On the surface, it looks great. It looks good because you're getting a better deal on the front end. And the provider can use those discounted rates two ways. They could use it to win your business in the first place and show you an immediate lift in F&I, because your managers are saving hundreds of dollars a contract and capturing that gross in the first few months and the difference of what the prices used to be. It feels like an immediate win. The problem is you no longer have enough premium to run a healthy reinsurance company, and you traded your back pocket for a bump in your front pocket. And nobody told you that's what they were doing. The new way, it starts with one question. What are your losses actually costing you? What is your loss cost on an earned basis? You take your current year-to-date loss costs and you run it against the loss ratio you want to run. So if your loss cost on an earned basis is $700 per written contract and you want to run a 50% loss ratio, then $1,400 reserve per service contract sold is a good starting point, and that's before inflation. And this is the discipline that most dealers miss, and this is the discipline that nobody keeps. You run that loss cost calculation every year. Every year you adjust your premiums, factoring in the new loss costs and anything that you've done on the store level to make the claims more expensive in the future, like a labor rate increase in your own shop. Auto dealers should be raising their rates on their products annually if they want a top performing reinsurance company. Not every 5 or 6 years the statement finally screams at you and says there's a problem. Every year you weigh it, you measure it, you adjust it. That's how you keep a healthy loss ratio, and that's how you never end up at 104% wondering what happened. Now, this is the part that most dealers miss, and it's the part that turns the whole conversation from playing defense into actually building something. Because so far we've been talking not about losing money, we've been talking about keeping the loss ratio healthy, so the thing that doesn't blow up. But the healthy loss ratio isn't the goal, it's the one thing that unlocks the goal. Let me show you what I mean. The old way. Here's the number that stops a dealer cold. The old reinsurance companies are set up to run a 20 to 40% return on premium. The new reinsurance companies are getting over 100% return on premium. Same dealer, same store, same customers. Wildly different outcome. And the difference comes down to two things: loss ratio management, which we just covered, and the asset side. What does your investment policy statement say? What does it actually let you do with the money? The old way. Most reinsurance companies out there are very limited on what you're allowed to do with the unearned premium to keep up with inflation. A lot of them won't even let you have a B account. They want every dollar, whether it's earned or unearned, every dollar sitting in that A account for as long as they possibly can in that trust account. And on the investing side, it's normal to find old style reinsurance companies that cap you at something like 15% in equities and 85% in bonds and treasuries. Safe, sure, but that's not gonna build generational wealth. It's barely gonna keep up. The new way does two things different. First, on the A account, the trust account, the newer companies will let you invest up to 50% in equities and 50% in bonds and treasuries. Now, I know what you're thinking. 50% in equities from 15, that must be, I'm taking a massive risk. You're not. You're still investing in a diversified stock portfolio. There's still diversification in there. It's just a better asset allocation that'll allow your investment advisor to grow your account faster. Already a different game, but the real difference is the B account. Let me explain the B account simply, because this is where the magic is. Every single month, a slice of premium sitting in your A account earns out. Once the premium is earned, the insurance company considers it to no longer have any risks attached to it. It's earned and it's surplus, so it's your money. So on a quarterly sweep, that earned money, whether it's cash or securities, it needs to move out of the A account and into the B account. And the B account doesn't play by the same rules because the B account doesn't have a claim to pay. They don't have to play by the same rules because that money is earned and it's yours and it's free and clear. You're allowed to invest up to 100% of it, 100% of the B account into equities. That's where you see reinsurance companies returning over 100% on premium. And let me be clear what I mean by 100% return on premium. What I mean by that is if $1 goes into your reinsurance company and it has 8 years to earn out, that dollar, when you pull it out in 8 years, you're gonna get 100 cents on the dollar coming back out. And that's only possible if you manage the loss ratio and you're allowed to get an investment, a return year after year on that dollar. So when I say return on premium at 100%, I mean for every premium dollar you put in, how many cents come back on that dollar when the contract is fully done 8 years into the future. And most companies, it's 20 to 30%. On these new companies, after investment income and a tightly managed loss ratio, these dealers are getting 100% return. And all that means, you think about it, is 7 years from now, the amount of money that you should be making on your interest in your reinsurance account should outrun the amount of claims paid in that 7th year. When that's happening, you're getting 100% or more. And let me bring it back to that dealer with 104% loss ratio, because this isn't theory. I ran the actual numbers on his book. Remember, this administrator didn't even allow him to have a B account. They're not even allowed to have a B account. They want it all in the A account. So I went back and I went and calculated the exact funds that they were invested in at the exact allocation that it said on their cession. I didn't change a thing. We stayed within their 85% bonds and their 15% equities. Then I modeled the business to create a scenario as if they set up a B account from day one with a quarterly sweep. And in that B account, they use the exact same stock funds that they were using in the A account, but this portion of the money they could have 100% in stocks. And just by adding a B account, that's it. It represented a 5% return on top of what they were already getting. A 5% difference compounded annually in the exact same investments they already held. They left that on the table for years for the dealer simply because their administrator wouldn't let them have a B account. That's how much the structure alone is worth. Let me translate what those return numbers actually mean for you, because percentages are abstract until you put them in your pocket. The old way is a 20 to 40% return on premium. This means for every dollar you put in your reinsurance company, after 7 or 8 years of those contracts earning out and claims getting paid, you get 20 to 40 cents back. You put in $1 and you get back a third of it. That's how the old school set it and forget it reinsurance company works. And most dealers are still sitting on one of those right now and they don't even realize it. They just say, I have reinsurance, I'm good, I checked the box, okay, next. And they don't really see the problem. The new way, you manage your loss ratio. You add premium when inflation says to and the claims costs say to. You're watching your loss claims data like a hawk. You're targeting a specific number, and let's say that that's a 50% loss ratio. And because you're allowed to invest up to 50% of that premium into equities, let's say you just saw 11 or 12% across the entire portfolio compounded return over 8 years on that portfolio. Now, every dollar the dealer put into the reinsurance company, they're gonna get 100% of that dollar coming back or close to it after all paid claims. And by years 8 or 9 and 10, your investment income is gonna outrun your paid claims. And that's how you build real generational wealth in reinsurance. You see the difference? The old way, you get a third of your money back. The new way, you get all of it back and then some. And you protected your customers' claims the whole time. That's not a small tweak. That's the difference between a reinsurance company that's an afterthought and one that's worth more than the dealership itself in 7 to 8 years. I repeat that. Your reinsurance company can be worth more than your dealership itself if you do this right in 8 years from now. And here's the thing I told that dealer at 104%, and it's the thing I want to leave you. A weak reinsurance company is almost never just a reinsurance problem. It's a symptom of a much larger problem. Most of the time, an underperforming reinsurance company is masking an underperforming finance department. And sometimes it's the only thing keeping that weakness hidden. Don't believe me? Try this thought experiment just for one moment. Walk into your finance office tomorrow and tell your managers, the rates on your service contract are going up by $900 a service contract. Tell me what happens. Do they tell you that that's impossible? Do they head for the door? Do they quit? Do your F&I numbers fall off a cliff the very next day? Because if you've got an underperforming reinsurance company, odds are really high that you're gonna need to raise premiums substantially to fix it. That's the medicine. You have to raise premiums to fix it. And the second you do, it unmasks every weakness in your F&I department that those low rates were hiding. That's exactly what happened in the store I just told you about. The fix on the reinsurance side exposed the real problem on the F&I side. If any of this is hitting close to home, if you don't know your loss costs on an earned basis, or you never had a provider walk you through a rate increase tied to inflation, or you're not sure if you even have a B account, that's exactly what we install step by step on this monthly webinar that we do on reinsurance. We hold it on the same day every single month, and that's the room you want to be in. If any of this is hitting close to home, and you don't know your loss costs on an earned basis, and you want help calculating it, or you've never had a provider walk you through a rate increase tied to inflation, you're not sure whether you even have a B account, that's exactly what we install step by step on our monthly webinar. We hold it on the same day near the start of every single month. We walk dealers through getting this running in their own store. Come and find out where your book really stands before your cession statement tells you the hard way. So here's the whole thing in one breath. Your loss ratio is a trailing indicator, so you can't wait for it to tell you that there's a problem. You reserve to a target loss ratio from day one. You raise your rates every year with inflation, and you run your company in a structure that actually lets the money grow. Do that, and you go from getting a third of your dollar back to getting all of it back and more. Now, if this is hitting home, you've almost certainly got to the second half of this problem too. The finance department, remember that $900 rate increase thought experiment? If that made you nervous, your reinsurance company isn't your only issue. I made a whole video on F&I performance coaching, what it actually is, and how it's different from the training you're probably getting in your store right now. That video shows you how to raise those premiums without your F&I numbers falling off a cliff. Watch it next. And if you want help looking at your own reinsurance position, your real loss costs, your real reserve, your total return on premium, the link is below to get that conversation started. And the monthly webinar is where we walk you through installing all of it. Remember, the happiest customer and the most profitable deal are the same customer. Go build that. I'll see you next time.